Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 31st of October and we have as our regular guest, Kelvin Wong, Senior Market Analyst from Oanda, as our guest today. Kelvin, it's always great to have you on the show.
Yes, good to see you again, Brian, and good afternoon.
Now, Kelvin, before we get your insights as usual, we'll take a look and see how markets have performed across the region in the first half of the day. But we will start with cryptocurrencies. Bitcoin is at 34,239. It's down 0.24%. Ethereum is at 1,799. It's up 0.93%. Now, looking across to regional stock markets, we will start first with where you're at, Kelvin. The Straits Times Index is down 0.02%. We've got Bursa Malaysia at the KLCI is up marginally at 0.1%. Shanghai is down 0.4%. The ASX All Ordinaries is down 0.02. It's up 0.02%. The Nikkei is up 0.22%. The Hang Seng is down a whopping 1.95%. And rounding up the numbers, we've got the Kospi, which is down 0.31%. So it's pretty mixed markets across the region. Kelvin, tell us why.
Okay, so firstly, for sure, what we see over here is number one, rather lackluster movement in the benchmark Asia stock indices. Why? Because we have a key China data release that is actually out earlier 2 hours ago. So that is the closely watched manufacturing PMI data and non-manufacturing PMI data from the Statistical Board of China, the NBS in short. So what's interesting over here is that the NBS manufacturing PMI actually came below expectation. So what market is expecting is another growth level of 50.2, almost similar of the one that we recorded in September, which is 50.2 as well, but unexpectedly it fall marginally lower at 49.5. So in terms of the PMI calculation, anything that's below 50, we are now looking at a phase of what I call contraction for manufacturing activities. So definitely that does not bode well for the Chinese economy, given the fact that in the last whole year or so, China top policymakers has been adopting what I call a much more targeted stimulus measure approach rather than an all-out stimulus measure kind of an opening of the floodgates that they were actually being used in 2014 and in 2008 during that period of time. So what's startlingly negative will be the services sector, where the non-manufacturing PMI growth slipped much lower in the month of October. So they actually came in at, give me a minute, 1 second, yeah. So the latest figure actually came in a tad bit lower as well, below expectation. So it came in at 50.6, way below expectation of 51.8, and also below a September figure of 51.7. So that actually is the yes, even though we kind of seeing it's a 8 month of what I call expansionary mode, but if you look at the last 4 months on the average, the growth trajectory has been falling to the north side, to the south side rather than the north side. So indicating to us that the non-manufacturing sector, which is we call it the services sector, is also getting soft as well in China.
So now this week, really, investors have been waiting for the Bank of Japan moves. We've just announced no change, but then there's something material that investors should be watching out for.
Yes, particularly if you are pretty much keen on the Japanese stock market, why even the FX market. So let me touch on this. What the BOJ will tend to have two policy. One is a policy on the yield curve control, where in the last 4 or 5 years or so, they used to actually target the 10-year JGB yield at a fixed percent. All right. So as we know that in Japan, inflationary pressure has started to pick up considerably and significantly in the past 1.5 years. And we take a look at the recent release leading Tokyo area CPI data for the month of October. The core rate, which excluding food and energy, has appears above the previous August year-to-date high. Right now, the October figure is at 2.7 year-on-year, which is a 31-year high. So if we take it to the consideration in the last 1.5 years, Japan inflation as a whole has been sticky on the upside above 2%, which is above the BOJ target for close to about 11 or 12 consecutive months. So to actually prevent to be or put away that to move in line with this upward inflationary pressure, what BOJ did over here is that in the last meeting in July, they revised upward the upper limit of this yield curve control program on the 10-year JGB yield to allow it to actually have more maneuver to the upside at this hard coded or hard limit of 1%. So in the last few weeks or in the past 1 month or so, this JGB 10-year yield has been moving in line with global, we call it yields across the board. As we know that the US 10-year Treasury yield on the 10-year has also been moving up pretty much steeply as well. So as we know that no man is an island, so that push up in the 10-year US Treasury yield managed to cascade a positive feedback loop in terms of yield that start to see further upside pressure on the 10-year JGB yield as well. So the 10-year JGB yield before today's BOJ announcement, it actually pierced up this morning at 0.9%. So at this point in time, it's actually inching higher at 0.93% as we are speaking. So that's coming very close to the previous hard limit mark of 1%. So this time around, what's interesting over here is that previously before, last night during US session, before the release of today's BOJ monetary policy decision to actually remove the hard limit of this 1%, the Nikkei Asia reported, according to we call it sources, say that the BOJ may increase it a new hard limit of 1.5%. But instead of using the hard limit of 1.5%, BOJ decided to subtly scrap this upper limit of 1%. So now this 1% will now be a reference level, and in its accompany diagram, it actually has this particular balloon box that actually pointing to a level that is above 1%, but no exact level of 1%, indicating to us that they will try to actually smooth up any rampant increase implied once the JGB yield appears above that 1% reference level. But there is no clear indication that when are they going to come into the market. So that actually gives the market, everyone guessing when BOJ will start to come into the market to actually intervene as in by buying up JGB bonds to suppress the 10-year JGB yield. So what it implies over here is that it seems to me that they're actually moving towards a much more clearer forward step in policy normalization from their ultra dovish policy since 2009. So implication wise for sure, what they're actually mindful right now is that the ongoing yen weakness has been creating a bit of imported inflationary pressure into the Japanese economy, where certain circles of the Japan political cycle has started to be putting downside or upside pressure on BOJ to actually act to actually negate this imported inflation, which could actually dampen investors, consumer and business sentiment. So with this new guidance coming out from BOJ, potentially it could actually, at least in the short to medium term, see a bit of positive reaction of the Nikkei 225, especially from demand-sensitive sectors like the retail trade, banks and financials. Because for sure, if we do not have a hard limit on the 10-year JGB yield, potentially we may start to see a steeper JGB yield curve, which could actually benefit a bank's net interest margin.
Now, that's a very interesting thought. On that note, Kelvin, thank you very much for your insights. Thanks for coming on the show.
My pleasure.
Now, we've been speaking to Kelvin Wong, Senior Market Analyst at Oanda. This has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out this show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.